What's going on, everyone? Welcome to Chart Basics. This video, we're going to be discussing on how to read a candlestick. Now, a candlestick is a visual representation of what price has done on a particular stock, index fund, or cryptocurrency. So this tells us whether price has been going up, price has been going down, or whether it's been moving in a range. So first, let's break down the 4 elements that make up a candlestick, and then we'll take a look at some live examples to bring everything full circle. So there's 4 data points on a candlestick. Number 1 is the open. So the open tells you where did the price open up for that particular time frame. Let's say we're looking at a daily chart. At 9:30 a.m. Eastern, when the stock market opens, where was the price of that stock? That is what the open tells you. The close tells you at the end of the day at 4 p.m. where was the stock price for that day. Then you have the high of day. This tells you the highest point that the stock price reached for that time period. And then you have the low of day, which tells you what is the lowest price that stock was traded at for that particular day. So in this example, on the left, we have a green candlestick. This means that the price closed higher than where it opened at the beginning of the day, and that formed a green candlestick. On the right, we have a red candlestick, which means that price closed lower than where it opened at for the day. So the other important piece of information besides the color of the candle are the wicks. And that shows you where the highest points of the day was and the lowest points of the day was. So at some point in the day, the price hit those very lows that are established by the bottom of the wick. And at some point in the day, the price hit those highs, which is established by the top of that wick. So why are we looking at these candlesticks anyways? What does it matter? The reason why traders and investors look at these candlesticks and data points is because it can give you clues as to potential trends in the market. So before we go into a live example, I'm going to show you a breakdown of how this candlestick actually formed with some price examples to make it a little more realistic. So in this example, let's say we opened at $50 and let's just draw a line that signifies the open here. Now this is your opening price, which is $50. At some point in the morning, the candle actually looked like this. It was forming a red candle because it opened over here and then it hit a low down here of $49. So if you were watching the candlestick form, you would see it look like this. You would start to see the red candle forming because it is going lower than where it opened. At some point, it found a low of the day, and what happened was now the stock price started to bounce and go higher. So at this point, now we're forming that wick. That's how the wick comes into play here, because it hit the low and then it started to bounce higher. Now, as soon as we cross the opening level, which in this example is $50, this candlestick is starting to turn green. So it's filling this candle higher like this as the day goes along. All right, so the candle's going green, it's going higher. And then at some point in the day, the candle goes to a high of the day somewhere up here. So now it's starting to look like this. However, by the end of the day, the price settles a little bit lower and we end up forming a wick at the top, and then price closes, let's say over here. So we hit a high of 55, but then price closed at 54. So now this candlestick looks like this. You have a green candlestick, and then you have a wick here, which is the low, and this is the open. Now, if the stock closed up here for the day, then there would be no wick at the top. The reason why there's a wick is because it hit this high of 55 and then it pulled back a little bit and it closed at 54. So that's why you have that wick over here at the highs and then you have a wick over here at the lows. So that's how that green candlestick actually formed for the day. If you're looking at it in real time throughout the day, it's going to look different based upon where it opens, where it hits the lows, where it closes, and where it hits the highs. All right, so now we're going to dig into a live example, and I'm using tradingview.com Currently, I'm not signed into my account. I do have a paid version of this software, but I'm just showing you what it would look like to you if you don't have a paid version of TradingView. They have a free access. The only downside is that you get some ads and stuff on the chart, but overall, it's a great platform to use, especially if you're starting off and it doesn't cost anything. So let's take a look. All right, so in this example, we're looking at SPY, which is an exchange traded fund, also known as an ETF. Now this tracks the performance of the S&P 500, which are the top 500 companies in the United States. So this gives you a good idea of how the overall stock market is performing. So each candlestick you see here represents 1 day of price action. And it's funny because the candlestick that just formed today, which is Tuesday, June 22nd, it looks exactly like the example that we just went over. So let's dig into it. Now, if you're not familiar with reading a stock chart, I do have a video in the description below on how to read a stock chart. So you definitely want to watch that as well, because that gives you a better understanding as to all the other dynamics that are going on in the stock chart. So if you highlight the candle with your mouse, you will see several numbers that I'm highlighting now, which is the O for open, H for high, L for low, and C for close. So in this example, we opened right over here, 420.85. The market ended up dipping a bit to 420.08, and then it came back up, hit a high of 424, and then it closed at 423.11. This is a really good example because it exactly matches the one that we just went through. So let's look at another example. If we look at the day before, which is Monday, June 21st, we had a big green candle, market opened here, hit a low, came back up, hit a high. You could see the little wick over here, and it closed over here in this level. Now, in this case, for this red candle, the opposite is true. The market opened up here, it hit a high over here, and then it sold down, hit a low at this wick, and it closed over here. So you can see that it's the opposite effect. Now, if we look at this candle, price opened up here, it hit a high, it went all the way down to this low, and then the price bounced and closed up here. Again, the red candles tell you that where the price closed for the day is lower than where it opened, so it forms a red candle. When the price is higher than where it opened, for example, on this candle and this candle, price closed higher than where it opened for the day. So that is your introduction to the candlestick basics. So as you dig more into the study of price, which is known as technical analysis, you're going to see that these candlesticks often give you clues based on how they opened, how they closed, where the wicks are, and where they are in relation to the other candlesticks in the chart as well. So putting this all together gives you a really good idea of the trend, the probabilities, and as a trader, that is everything. You want to be able to know where's price been, where can it possibly go? All these factors come into play when you're trading, and understanding the candlesticks is huge because that gives you an inside look and a clue as to what is potentially next. So there's no future telling in the market, but studying price patterns and behaviors can give you a really good idea of what's coming next. All right, so you made it through how to read a candlestick. Hopefully this was useful to you. If you got value out of this, please hit the like, subscribe to the channel if you haven't already, and leave a comment below. Let me know what you liked about it, and if there was anything that I missed that you want to see more of in the future. Thanks for watching.